Today we're going to look at emergency funds and why I think that they are a load of malarkey. Amortization, a bit of a difficult one to say that. So today we're going to look at emergency funds and why I think personally they could possibly be a bit of tat. So emergency funds, basically what we're going to look at today is what are emergency funds and why I personally think, I'm not sure if everybody really truly needs them. So your unique circumstances. So emergency funds. So basically, if you're working a job or you're running a business or whatever, you need to apply like a kind of 20, 60, 20% rule. So you say 60% is your like operating costs or your living expenses or whatever. 20% of it is your kind of saving, if you like, and then 20% would be your emergency fund. So 40% of what you earn or take home should be some kind of savings or for an event in the future. So you've got a difference between 20% savings and then 20% emergency fund. Savings, I mean your pension, I mean your kind of, reserve fund if you're a business or something, or maybe investments or something like that, or saving for a property or whatever it is. The remaining 20% is like your kind of cash loose emergency money. So the difference between the different types of saving is that your cash money is immediately available to you. It's very liquid, if you like, is what we refer to it as. And you can deploy that if you lose your job or you lose a big client or something happens, some big bill comes out of the middle of nowhere. You've got this liquid amount of money that you've sat aside and you've got in your like kind of savings account and you can access instantly. That is different to your kind of money that's in your pension, which is obviously locked up to your 57 in the UK or your, is it 401 or something in America, whatever the other thing is. But everywhere in the world has like some sort of pension scheme, but it's generally locked into your kind of retirement age, which will vary. You might have your ISA. We have a ISA in the UK where you can put money aside and the growth on it is tax-free. So all those things might be there. And you might get like a COVID or coronavirus type event happen or a stock market crash or whatever, and then your value of your pensions and your ISAs go down. You don't want to be dipping into it at that moment in time because it will probably recover, or it always does recover over a period of time. What you need to have is your emergency fund. Now, some people will say the first target is to have a month's worth of emergency fund, then build up to 3 months, then 6 months and go from there. So it depends on your risk tolerance as to exactly how much money you need aside. We're not talking about your kind of Netflix and stuff when you come up with a figure for your emergency fund. We're talking about all of your compulsory spending, so your heating, your lighting, your roof over your head, whether that's mortgage or rent, food. You need all those things to live, but you don't need Netflix or whatever to live. Obviously, if you're signed in for like a 5-year contract or something, you might want to consider that. So it's your risk tolerance. We'll come up with that figure, and the first target is to do monthly, then 3 monthly, then 6 monthly. It's the same with a business as well. You might say, well, we've committed to a rent on the properties and all this kind of stuff, heating, lighting, wages, all that kind of stuff. And you go, right, I need that kind of set aside, if you like, just in case a big client doesn't pay us. It's equivalent of losing your job essentially, or somebody walks off from the business. So that's kind of your emergency fund, different to your savings and then different to your kind of minimum living expenses or running costs of your life, if you like. So one could argue, and there are lots of people that argue, that actually to some degree a reserve fund is a little bit irrelevant if you've got certain things in place. So I'm not saying that they're complete malarkey. If you're someone on a fairly low wage or maybe a startup business or something like that, you may need to, or you will need to build up that reserve fund. It's maybe your first port of call. But let's say you've got, I don't know, £100,000 in savings because you've done very well over the last 10 years or so and you've put a lot of money aside, but you've also now got £10,000 worth of, that's 9 months worth of living expenses because you've kept your expenses very, very low. I would argue that you could take your £10,000 and probably put it into your ISA or your pension, and it will return you a lot more money than it's going to return you in the bank. but you've also got all of that money in your bank. So if there is a bit of a dip in the market, you're going to be able to pull upon that money. And yes, it would have gone down. So let's say you're buying shares of some stock or something like that, and you're investing in your pension, or you're buying a basket of funds like an ETF, S&P 500 for example. At the moment it's trading for about £85 a share. Let's say it fell to £75 a share, so you're going to lose £10 for all that stuff you've invested. But the thing is if you're fairly stable where you are, the £85 you might have only paid like £50 for the share, so therefore it's going to have some money retained in there anyway, and you can draw that money out if you need to. So how much money do you need is the point of why I call it malarkey. I mean, you can have savings pots for savings pot and a saving pot to protect the savings pot just in case the interest rate goes down on the savings pot. So just wanted to leave the video quickly just to remind you about some other key tips. So if you are someone that is perhaps struggling with debt, have a check out of our credit card and how to get out of debt video, and really kind of have a look at that and see if you can then get out of debt, and then you can then start to invest some stuff aside. Then we also done a video on how to invest money as well and how to get started with that. And finally, if you wanted to actually earn some extra money on top of your normal day-to-day wage, whatever that might be, check out our video on side hustles. You've got credit card debt and you've got how to invest. So those are those free kind of really good videos that will help you, and you can feed them into this video. So with that said, we'll get back into the video. Hopefully you like that little cutaway. But the banks will only ever give you like 1 to 5% at best, and even when you get 5%, it's normally capped on a certain amount of money in the bank, so they're not great returns. You can get 10-12% in the stock market and it's fairly passive, or you can invest in property and things like that. You need to figure out your risk tolerance, but for I think anybody that's built up like at least a small amount of wealth or whatever, reserve funds are kind of a bit pointless really. You could probably make that money work harder. So that's why I believe for a certain demographic, reserve funds or slush funds, whatever you want to call it, emergency fund, is rather irrelevant, and you can utilize that money in a better format. I'm not saying that if you're kind of starting out in your working career, maybe you're 18, 19, you want to move out, then maybe an emergency fund is good. And obviously if you're saving for something like a deposit on a house, for instance, you don't want those short-term fluctuations in the stock market. So again, I would save that outside of it. But for anybody that's fairly stable, so maybe you're in the middle of your life or something, you're middle-aged or whatever, then you might think to yourself, I have enough behind me to not have this emergency fund, if you like, if you want for a better word, but this set of money aside that I can instantly access. And one of the things that annoys me most about it is that people always forget that if the bank's giving you like 2%, but inflation's at 5%, your cash in your bank is actually losing money. You might think it's making 2%, but it's losing 3% against real buying power. Think of it, if I loan you £100 today and I ask for it back in 10 years, £100 today goes out and buys a family for 4 a nice meal at a restaurant. In 10 years time, I don't reckon that will even buy 2 people a nice meal out in a restaurant. So it's lost its buying power, and essentially that's what happens if you're not even getting what inflation is. Inflation in the UK is about 5% at the moment, so in order to stay in line and your cash not lose any money, you need to be at least getting 5% return, which is fairly difficult for what I describe as small sums of money. I know £10,000 is a lot of money, but it's small to the banking industry. You're not talking hundreds of thousands or millions, so they won't give you 5%. Might give you 5% on the first 5 grand, and then it will probably drop down to 0.5% after that. So that's why I feel that they are malarkey for certain demographics, basically. You may agree with me or disagree with me. Please, I'd love to hear your comments in the room. Take me on. We'll have a little debate in the comment section if you want. Yeah, I hope this video's been fairly useful to people that want to know about kind of reserve funds and, you know, kind of money set aside for life's eventualities and my views on them. So if you like the video, please don't forget to subscribe. Head over to all the social media platforms, Instagram, Facebook, all that kind of stuff. We're all there. Please, you can even listen to this on audio if you want to. But yeah, with that said, I shall see you in the next video.